Subscribe to LearnCab and hit the bell icon to get notified.
Hi, welcome back. After material and labor, now it is a term of overheads, variance, which is very important for us to understand. So, in variance, overhead variance, we need to talk about two important things. One is fixed as well as variable. So, we need to break it up into fixed overhead variance and variable overhead variance. So, let us go back to variable overheads variance first and understand what is this the components under variable overhead variance are. So, first of all, it is variable overhead cost variance, which needs to be arrived at. Then we need to even analyze for variable overhead expenditure variance and variable overhead efficiency variance. So, these are the components: cost, expenditure and efficiency. So, we need to analyze variance in first two things, that is fixed, variable. Then we need to go for further study of what is variable overhead variance means. In that, we need to analyze what is variable cost overhead variance, and what is the variable overhead expenditure variance and variable overhead efficiency variance. So, these are the things which we need to analyze when we go for variance analysis in terms of variable overheads. So, let us study the first one, variable overhead cost variance. What is this variable overhead cost variance? So, it is the difference between standard variable overheads for production and actual variable overheads. It's same, the principle remains same for material cost variance, labor cost variance and even variable overhead cost variance also. That is basically take standards and subtract it from actuals. Okay. So, that is what it means, very simple thing. Next, let us go to the next very important thing, variable overhead expenditure variance. What is this expenditure variance? It is the difference between standard variable overheads for actual hours and actual variable overheads. So, how do you calculate it? In a simple formula, since it's something to do with expenditure, rupees. Okay, please remember, expenditure means rupees. There we talked about rates. Here we are talking about expenditure. So, variable, since it's something to do with rupees, expenditure is something to do with rupees. In bracket, we are taking the terms which are related to rupees. That is, one is standard rate, another one is actual rate. These are all both in terms of rupees only. So, standard rate minus actual rate, since its expenditure is rupees, we are taking net of rates here in brackets. So, multiplied by your average hours. So, this is important again, average hours will come outside, your standard hour rate and your actual rates will come in the brackets. So, this is only for overheads. So, you need to be very careful, do not take the hours of labor here, it is hours for overheads. So, what is the total hours which you have been incurred for that particular overheads? So, hourly rate differs here. So, we need to be very careful of taking the hours from the problem. So, do not take labor hours here. If you take, then it will go for a wrong. Okay, it will be labor rate what you will be comparing, then not your expenditure here. So, when you talk about expenditure, it is overhead hours, okay, which is important. It can be machine hours, it can be any other hours what they have given in terms of comparability to overheads. So, absorption is based on hourly rates here. So, if they have given hourly rate separately for fixed and variable, it needs to be taken, or if they have given the proportion under which the fixed and variable hours needs to be allocated, you need to take that hours and you need to do it here. So, remember the formula, since it's expenditure, in bracket it should be in terms of rupees. So, standard rate minus actual rate, that is what in bracket it's coming, multiplied by actual hours of overhead. Okay, so of overhead, please remember actual hours of overhead it is, not labor or something like that. Don't get confused with those things now. Okay. Next one, variable overhead efficiency variance. So, since it's efficiency, definitely it should not be in terms of rupees. So, in bracket it will not be in rupees here. Okay. It is the difference between standard variable overheads for production and standard variable overheads for actual hours. This is the formula. So, how do we express in simple? See, in bracket it is hours It's not rate here, okay. So because it is efficiency, efficiency is measured in terms of hours here. So it is standard hour, SR, open the bracket, it is standard hours minus actual hours. This is the formula. So please remember this formula. There it will be H in, if when you talk about expenditure, we are taking outside bracket H, that is actual hours, multiplied by net of your rates there, standard rate minus actual rate. Here we are just going for the other around the things, because we are measuring efficiency. Efficiency needs to be measured in terms of your standard. So how do you measure you are doing good? Only on base, you need to compare your base. Okay, my current year, this particular semester I have scored distinction. So how do you compare that, whether you have improved upon your studies or not? What is your efficiency in study? If you want to compare, definitely you need to compare with your last semester exams. So what happened after last semester exams, whether it has gone up or come down? So that is efficiency. Efficiency, whenever you are comparing, it should be compared with the base period. So in our variance analysis or standard costing, our base is standards. So that's why we are multiplying by standard rate when we are talking about efficiency. All material, labor, wherever you are talking about efficiency, right, you multiply by standards only. It's not actuals. So when you are talking about rates, we are talking about today, what is the position. So I am comparing it with actuals there. So I am multiplying by actuals because I want to know what is as of today's situation. But when I want to talk about efficiency, efficiency is a factor which needs to be compared with my previous thing. So I should keep something as a base and see whether that I have significantly improved upon over my base period. So what is base here? It is standard. So I compare my standards with my actual. That shows what is my efficiency. So whenever you are multiplying any factor, right, it should be by standard factor itself. You need to multiply in order to measure efficiency. That's what we have done here. So standard rate, open the bracket, net of your hours. What is the net of your hours? Standard hours minus actual hours. So why did I take hours? I took hours because I am measuring efficiency. Efficiency will not be in terms of rupees here. So efficiency will terms of hours. How much hours I utilized? How much hours of capacity I used? So what is that I have saved or extra consumed? So that is what efficiency means here. So we need to be careful, and there are some logic in understanding these formulas. If you can think and understand in those ways, right, I think standard costing becomes a very easy topic to remember. And out of experience, most of the students will not apply this particular problem. They will just go for 1 or 2 steps and they will ignore it. It's a waste of time. Don't do it. So if you are only comfortable enough with the formulas, if you think that yes, this is a problem which I can attend, yeah, and I am familiar with all the formulas of variance analysis, then only you do it. And it's a scoring subject. Only it will be direct questions, no need to calculate too much in this. So only if you apply the formula and if you can analyze what is favorable, unfavorable, and one sentence will be there at the bottom to interpret that variance. So if you can do it, it's fully scoreable subject. You can easily score marks in this particular topic. Then overhead, variable overhead expenditure. So what is the labor rates? Sorry, it should not be labor rate here. It should be overhead rates here. Expenditure or variable expenditure rate. Sorry, its slide is wrong. I'll correct the slide. Okay, I'll change the slide. So unexpected saving in cost of services, that may be a favorable reasons for this rates getting correct. Then unexpected increase in cost of services may be adverse. So what is a variable overhead expenditure we are talking about? That is how much of the cost you have incurred has gone up over a period of time, that is when compared with actuals. So favorable is if you are saving cost, it's favorable. Okay, that is you are not incurring extra money on doing the same activity. But if you are spending more money on that, if your expenses is going up, then it is adverse effect. Then second one is more economic use of services, that is how effectively the overheads have been utilized in delivering the production chain. That is very important. So services also are there here. So we are concentrating more on the overhead implication on the activities what is contributing towards production. So here more economic use of, economic use means economy means how optimum use the services have done. So how maximum you can use it at optimum level. So that capacity level, if you have used your resources, then definitely that will result in more benefit, less cost. So that is what it indicates. This particular thing indicates in favorable. The next part is on adverse. Adverse part is less economic use of services. So less economic use of services again is something where your optimum planning is not done properly. Even though availability was there, it was not utilized at the fullest extent. So this may result in your expenditure going up. So once expenditure goes up compared to your standard, then it is an adverse impact on the system itself. So that is what the inference you can draw when we talk about the expenditure rate, expenditure variance, sorry, not rate, expenditure variance here. Then we have done with fixed variable. Now let us go to the fixed overhead. I told you need to study overhead in two parts, fixed, variable, both parts. Okay. Now let us study what is this. So again, it's the same thing which repeats here, same concept. So only thing is the formula, little bit of changes will be there. There you are taking overheads, the variable part only. Here you need to take only fixed. So the challenge lies in examination that you need to clearly know what is fixed and what is variable part. So that is the only challenge. In overhead, you need to be able to identify what is fixed and what is variable. That is what is directly varying with the number of units is variable overheads. That which remains fixed irrespective of number of units you manufacture, right? That is called as fixed. So overheads, fixed and variable classification is very important, and based on that you need to arrive at this in variance analysis. So it's almost same thing here also. So three important thing, one is cost, one is expenditure, and the other one is volume, here. So here slight change is there. There we talked about efficiency, here we are talked about volume, that's it. Okay, overhead we talked about variable overhead, efficiency variance. Here variable fixed overhead, volume variance we are talking about. So that is the only change here. The other two remain same. Cost, there also we had expenditure, there also we had. Only thing change is there we had efficiency, here we are having volume. Let us see what is this formula stands for. So again in volume we need to go for another two things. One is capacity and the calendar. So calendar, as the name itself tells you, it is based on time. Okay, because fixed cost is something which is time oriented. Till that time it remains fixed. Okay, so how long or how many years or how many months that cost will be fixed, that is very important for us to analyze, because how fixed it is, that cost is, that plays a prominent role in my decision also. So then we have capacity also, because fixed cost depends on capacity. So utilization of capacity, to what extent I use that capacity for which I incurred so much cost, because whatever the capacity level you are using the same fixed cost. If it is unutilized also, fixed cost is incurred. If it is overutilized also, same level of fixed cost is incurred. But the apportionment and applicability of the cost in terms of how that particular product consumes that fixed cost is very important. So that is where the challenges lies, or else your contribution should go up when you want to recover that fixed cost if it is at the under capacity utilization thing. So fixed cost, irrespective of whether you want or not, you are incurring that cost based on your how much you are supposed to pay, irrespective of the capacity at what you want to operate for. So if you are incurring a fixed cost and if the capacity is not getting utilized, then it's no point in incurring so much cost when capacity are so less. So these are some of the important things which we need to understand when talk about volume, fixed cost, volume analysis, variance, that is where we study all these things. Let us go in deep and try to understand what are the different formulas which are there in this fixed overhead variance. Then of course efficiency variance will be there. Let us see what is this. Difference between absorbed fixed overheads and actual fixed overheads. If you remember when I was talking about the first part of my explanation on this standard costing, I told you there are two important things we need to remember in costing. First is initial cost, and the next one is recovery cost. These are the two important things. Costing goes by this principle. Costing goes by initial costing, then recovery costing. So recovery costing is absorbing the rates at the time of actuals. How do you cost that, and how do you absorb your over and under absorption at the time of finding the difference? That is called as recovery cost. So we need to be very careful when we are talking about absorbed fixed overheads. So that is the actual overheads which is getting absorbed in the production process. So actual fixed overheads is what is that actually you have incurred it, but out of that actual, everything will not be absorbed. So absorption takes place based on some predetermined activities. We know that this is what that particular fixed cost should be absorbed for this activity. So at 30,000 capacity, if you are incurring a fixed cost of, let us say, 10,000 rupees, you cannot increase if your capacity falls by 25,000, there also you are incurring 10,000 fixed cost only. That doesn't mean both sides you should take the same cost. So you will be absorbing your cost depending upon the capacity utilized. That's how you need to do it. You need to go by some rates, and it can be any rate, direct wage rates, or some predetermined rates may be there, or machine hour, man hour rates. So there are a number of rates which are available, most suitable for your industry, that needs to be taken, and accordingly the cost needs to be absorbed. So there is no point in absorbing 10,000 rupees fixed cost which you pay for 40,000 capacity, and if you are operating at 20,000 capacity and again you charge 10,000, there is no point in that since it's an actual cost. No, that's not the way. So recovery rates are something different. So costs are recovered at an absorption rate. That's very important. That is what they have told here, absorption rate. So at what rate the fixed cost is absorbed and what is the actual fixed cost, that is important. So you know what is that you are paying every month as fixed cost. That is your actuals, whatever you are paying. But what is that which got absorbed? So absorption is based on how much capacity you utilize. To that extent you are absorbing the cost of fixed cost. You are not absorbing the total fixed cost which you have actually incurred. So that difference is called as your fixed overhead cost variance. Next, fixed overhead expenditure variance. It is the difference between budgeted fixed overheads and actual fixed overhead. So every time when I prepare a budget, I know what is the actual, what is the cost I am supposed to incur for my fixed overheads in that particular year. I make the provisions for all these things based on my agreement, whatever I've signed, because these are something, since it's future oriented, most of the things I'll be having my numbers right here. So most of the time numbers will be right. Most of the time numbers are derived from the contracts or agreements what I enter into. So I predict the cost what it should be. So fixed cost as such I have budgeted over my period. So that is my budgeted fixed cost. This is my budgeted fixed cost. So fixed cost in terms of, please note, I am talking about only overhead. So budgeted fixed, if I am telling, it's only on overhead part I am talking about. So whatever the budgeted fixed overhead cost is there, that deducted by your actual. So what is that actually you have paid in that period, that tells you what is your expenditure variance. So this is very significant part because it tells you how much extra you are paying every month, and this is something which needs to be worried in the financial matters, not in your costing aspect, because cost is going by absorption rates. So this only one important vital thing is about your bringing down your fixed cost. Is there any chance where I can play around my fixed cost? So that is the management decision what they will be expecting from this particular variance. Then volume, fixed overhead volume variance. It is the difference between absorbed fixed overheads and budgeted fixed overheads. So there it was just you can see the difference here. It was budgeted fixed overhead minus actual fixed overheads. Here it is budgeted minus absorbed. Absorbed is what is actually getting absorbed in your process. So what is that, at what rate you absorb that fixed cost, fixed overheads in your production process? What is that you have absorbed it? I told you it depends upon n number of factors. So you need to fix based on some predetermined rates, you absorb the fixed overhead cost. So at what is the amount of that absorption you have done? So that difference you need to compare with your budget, not with actuals. If you compare with actuals, it will go to the first point what we discussed. So when we compare it with budget, it leads to our volume variance. So what is volume variance? In simple, it's a difference between your absorbed fixed overheads and your budgeted fixed overheads. So whatever the budget is there, you have prepared already what is that amount and what is that absorbed amount as of today. So for that particular period, that minus this gives you what is your volume variance. Next, calendar, I told you it's something to do with days. So let us see what is the formula. So standard rate, open the brackets, actual number of working days minus budgeted working days. So here we are going by number of days. Calendar means days. We are talking about days. So what is that actual number of days you have worked for, and what is that budgeted working days you had planned for? So when you multiply by your standard rate, you will come to know what is the fixed overhead calendar variance. So calendar variance is very important because it helps us in planning the time properly. So what are the minimum number of days you need to plan for in order to bring the fixed overheads under your control? So how many days you are spending on this, how many days you are using out of this fixed cost? Because fixed cost as such, it is either paid on weekly, monthly or some period basis you are paying it. Regularly you are paying it at a regular intervals. So is there any possibility for going for negotiation if I can save some time on that? So that is one important vital decision what you will be taking by doing this variance analysis of fixed overhead calendar variance. So it is basically to bring down the time factor. So if I can bring down the time factor, is there any possibility for me to negotiate on the payment of fixed cost? So normally fixed cost is fixed on some fixed rates over a period of time. So 30 days you pay me so much rent. Every 30 days, okay, you pay 360 days divided by 12, okay, divided by 30 days, that is 12 months. So 12 months I will be paying so much rent. That's that's how it's fixed. It's fixed on the number of days. So it becomes very important if I can just talk about what is the actual working hours and what is the budgeted working hours. So if I can save, then there is a possibility of even going for negotiation to bring down the fixed cost also. So try to make some alternative arrangements with different people wherein we can just bring down our fixed cost also. That is the ultimate objective of this. Then capacity, so difference between standard rate and actual hours and standard rate of budgeted hours. So this is purely about SR into AH minus BH here. So you are talking about BH, BH is nothing but budgeted hours. So we have actual hours, we have budgeted hours. So take the net of these two, because capacity, efficiency, capacity, all these things are parts of hours, not relating to money. Capacity if they are asking, or if they are talking about efficiency, bracket should be always hours. Okay, so please remember, it should not be rates R, it should not be R, it should be H only. So here also same thing we are doing. SR we are taking AH minus BH. BH is budgeted hours. What is your budgeted hours? So that will be already available in the system for you. So at the time of preparation of the budget itself, they will tell, okay, the plant put into production for so many hours in per day. So in order to manufacture so many units, those things and all will be done in the basic costing itself. So standard rate, open the bracket, AH minus BH gives you what is the capacity variance. Okay, that's very important. Then fixed overhead efficiency variance, very simple formula here, standard rate into AH minus SH. So here SH is coming instead of BH. There it was BH, that is budgeted hours was there. Here we are talking about efficiency, we are talking about SH, that is standard hours. So that is the only small change in the formula. So if you see the formula previously, see that capacity it was AH minus BH. Here it is AH minus SH. So SH is coming in spite of BH here. Okay, here it was BH. So that was capacity, efficiency is SH. So that is the only small change in the formula. So what is the difference between budgeted and standard? That's one question which is popping up in your mind. See, Standard costing application is based on predetermined rates. It is based on technical aspects. It is based on some research, some oriented, some you have drilled down into that. You have a lot of interaction with people in that, and you have technically told that this is how it should be. So you have done a lot of exercise in order to fix a predetermined rate. But budgets, you don't do so much exercise. It's a overall factor what you are concerned about. So when you are fixing the budgeted hours, you are not going by the internal evaluation of that particular activity or process and then doing it out. No, it's not, technically you are not doing anything there. So you just went by your actuals of previous, and you are supposed to think of what it should be the future. So based on that, some formula use and you find it out. So it's a more mathematical way of working out here in case of budget. It's an estimate you are doing. But in case of standards, it's not only mathematical, it's even application of technical oriented skills also. So you need to come to a conclusion there by applying your thoughts, meeting people, discussing with them, fixing the standards based on that. It's not only just simply you cannot predict some figures or something like that. It should be justifiable figures. How did you arrive at that standard? You need to establish those standards figures. You need to own that standard figures. You need to tomorrow be held for responsible for all those figures whatever you have given. But in budget, you will not be held so much responsible because it's only the estimates what you are doing. It may go either way there. Okay, so the responsibility and accountability in case of budget fixation is there, but it's not to so extent where it is there in case of standard costing. So that is budgeted hours and standard hours. So when we are talking about capacity, we talk about budget hours. When we are talking about efficiency, we talk about standard hours. That is the only two things, a small change which is there in the formula which you need to remember. Then fixed overhead expenditure variance. Let us see what is the difference here. Normally the difference of adverse and favorable we can interpret like this. Any decrease in price, it's a favorable, because any decrease in price of your fixed overheads, right, definitely it will bring a big game changer when you compare it with standard, because standards you assume that you predetermine that this will be the cost actually, but because of negotiation and because of the economic impact and all those factors, the prices have reduced. There is a decrease in price. Okay, so that will contribute towards favorable balance. Next is increase in price. Again, it's an adverse effect because it pushes your cost up. So when the fixed cost goes up, right, the only alternative to make more profit is that you need to bring down the cost, because fixed cost can be recovered only if there is a huge contribution. So again, there is a pressure on your sales now. Okay, pushing up the sales is a very important aspect which you need to try to aim at. So it's an adverse effect because it pushes your costs up. Then seasonal effects are one of the reasons for change in which may create in favorable balance in case of fixed expenditure, but seasonal effect will be also adverse effect here. So what is the seasonal effect we are talking about? Seasonal effect is the temporary shift in the demand due to change in the season. So that factor also should be there when you are going for fixing of the standard. So I told you, right, it should be justified. How you are arriving at the standard cost, each and every factor needs to be justified, then only standards should be fixed. So seasonal effect has impact on both. It can act as either a positive or a negative way. So favorable effect may be because of seasonal changes, or it may be even because of seasonal effect also, adverse effect may also be there. So it may go both the ways. That's what it means here. So next is fixed overhead volume variance. So what are the favorable things we can talk about? Increase in production volume. So see, fixed cost doesn't directly relate to number of units you manufacture. You manufacture 0 unit, still you need to incur fixed cost, same fixed cost. You manufacture 1000 units, same fixed cost. 10,000 units, same fixed cost. 1 lakh units you manufacture, same fixed cost. So fixed cost remains same. Okay, overall it remains same. Per unit it varies because you are dividing total fixed cost by total number of units manufactured. So per unit it varies. Overall it remains fixed. So when I am talking about this, what is this favorable I am talking about? How come this increase in production volume? leads to favorable. See, what is this increase in production volume? Irrespective of number of units increase, right? Fixed cost doesn't have any implications. Okay, so nothing to worry about fixed cost. Fixed cost needs to be worried only when you are not manufactured anything, because it's an unnecessary burden on you to pay that amount, even though there was zero manufacturing at that point. But more and more the numbers you go for manufacturing, right? Volume increases means fixed cost per unit comes down. So the recovery of fixed cost, whatever you are incurring, the chances will go up when you manufacture more and more units. That's why it's a favorable thing. But what is unfavorable is decrease in production units. Why decrease in production unit? Because lesser the number of units you manufacture, per unit cost goes up, because total number of fixed cost, total amount of fixed cost divided by total number of units you are doing. So lesser the numerator, more the denominator will be. Okay, so more the numerator, lesser same level of denominator remains, because fixed cost is same for both favorable, unfavorable. So it is highly disadvantageous, or it is unfavorable when the production comes down, because your fixed cost absorption into your product cost is very high when we talk about adverse effect. The next one is increase in demand. Increase in demand, we are talking in terms of the market demand. So when there is a huge demand for manufacturing of a particular product, orders are coming in time, and more orders are flowing into the production system. That means your fixed cost, chances of recovering the fixed cost is high. So the cost per unit, absorption of fixed cost is coming down. That's what it means. But when we talk about adverse effect, whenever there is a decrease in demand, so decrease in demand is because of various reasons, and if the demand for that particular product is coming down, that means your manufacturing activity is also not continuing, because when there is no demand, there will be no manufacturing also. But fixed cost needs to be incurred even though you don't manufacture anything, even though you close your company for that particular month because of no orders, no demand, still fixed cost is incurred. So it's an adverse impact if the demand is decreasing. So it relates to problem. So these are the things what you need to analyze when you do variance analysis. So variance analysis is a very important tool for doing all this analysis. Change in labor productivity. So how does fixed cost and labor productivity go hand in hand? What is the logic behind labor productivity and fixed cost? See, the ultimate thing is fixed cost, irrespective of whatever you do, right, it is incurred. So it is nothing to do with any other factors which comes in the process. But what is this change in labor productivity and production loss through strikes? What is this? See, if the labor productivity is increasing, okay, if the labor productivity is increasing over a period of time, then fixed costs are getting recovered at a very faster rate. So more units you manufacture, the particular per month fixed cost what you are supposed to incur is recovered within a short span of time. You are at a process of recovering at a very faster rate of the fixed cost, because productivity is more the productivity, lesser the days you take in order to absorb the fixed cost what you are supposed to incur. So that is what it means. It is a favorable balance here. Then what about the adverse effect? Adverse effect is if production is lost through strike. So that means you need to wait for some more days in order to recover the fixed cost which you have incurred. So more the time you are losing because of strikes and other reasons, more the chances that your fixed cost gets deferred to be recovered over a period of time. So this is something which is acting as a multiplier factor in order to recover the cost, which is not good in terms of long per se of the industry's survival. So this is what adverse impact of your productivity not going in hand with recovering the fixed cost at a faster stage. So this point needs to be borne in mind when we are talking about all these things. Then we are coming to the last part of variable cost analysis formulas, which is sales variance. This is a very important variance which needs to be done, and apart from your material, labor and overheads which is forming part of your costing system, sales is also a very important point which you need to understand. What is this sales variance? Let us see that. So actual sales less budgeted sales. This is in simple terminology, this is the difference. So what is that you budgeted and what is that sales? So you prepare a sales budget, right? You know that. So where did you stand? How did you fix your standard for sales? So what is the volume of sales you wanted to achieve and what is that actually you have achieved? So the difference between actual sales and budgeted sales is sales variance. Then what is sales price variance then? So sales price variance is actual sales minus standard sales. Please note two difference there, budget sales and standard sales. So sales price variance is variance in the price of the sale, whatever you have done. So that when you have fixed some standards, that this is what the sales I was supposed to achieve. This is at that rate of sales I should have achieved. The number of units multiplied by selling price. This is what the rates I am expecting for. But what is it actually turned out to be? That difference is called as sales price variance. Very important point. Okay, please remember the formula. This year for the first time we are seeing something called as AQ, that is quantity. This came in materials now. Okay, now we are seeing in sales. So average quantity minus, open up your bracket, actual price minus selling price, standard price, sorry, actual price minus standard price multiplied by what is your actual quantity. That gives you what is your sales price variance. Then sales volume variance is there, next part, which is also a very important. What is this volume in terms of number we are talking about? Standard sales minus budget sales. Here it should be in terms of numbers or units, whatever they have given, quantity, kg, quintal, whatever it is. Okay, so we are talking about volume here, volume in terms of numbers. Okay, standard sales minus budgeted sales. Or formula is SM into AQ minus BQ. So volume means quantity, that's what. Try to link like that. Rate means rupees. Volume means quantity. Capacity means hours. Like this you just link it, link the subject, okay. So here it's volume. We are talking about volumes means we are talking about quantity. So what is the difference? It's a difference between actual quantity minus budgeted quantity. Be careful. It's budgeted quantity, not standard quantity. It's budgeted quantity. So you prepare a sales budget. You get inputs from that. What is that you have projected for the next quarter or next half year or next year. So that is your budgeted quantity. So actual quantity minus budgeted quantity gives you a net quantity. Okay, net surplus or net deficit quantity you get, that multiplied by your SM, that is your standard volume rates, whatever you have fixed, right, that will give you standard volume variance. That's very important. So SM stands for standard margin. What is the standard margin? Margin at which you are predicting your sales to go for. That is called as SM. So standard margin is the margin at which you are predicting your sales should be achieved at, or what is the rate at which you need to sell that in your future. Okay, that is the margin which is fixed at the time of fixing the standards. So SM, open the bracket, AQ minus BQ, actual quantity minus budgeted quantity. So this will be budgeted quantity, you can get it from budget. Actual quantity, actual figures, quarter figures, half yearly figures or yearly figures, whatever volume of sales you have done, that is the quantity numbers which will be there. So if you do it, then you can get what is the sales volume variance. Then we have sales mix variance. So when I tell mix, different components which is getting into the sales, which is contributing towards your sales revenue. So standard sales minus revised standard sales. So whenever I am revising it, I need to revise keeping actuals in mind. So whether it's labor mix variance or material mix variance or whatever it is, please remember, whenever the term mix comes into picture, we need to compare that standards with actuals and take the proportion of actuals to standards. Okay, that is how we need to work it out. So for total, so much is the standard, means for actual, how much should have been the standard. So that is how the proportionate needs to be arrived at, and you need to rework this and you need to calculate the formula. So standard sales minus revised standard sales, RSS, revised standard sales. So this is a very important formula to understand sales mix. Sales quantity variance, it is revised standard sales minus budgeted sales. So whenever we are talking about quantity variance, we need to compare it with budget. So standard is getting compared with budget here. So quantity standard, this acts as a triggering point for next year standards. Okay, so whenever I want to redefine my standards, or whenever I want to go for changing my standards, this acts as a triggering point because my budget is already there. So I will compare my budget with standards and see what is the variance. So that will be one of the factors, guiding factors for next year for me to consider those things in my standards. So that is how it aids in next year planning of your standard, fixing of standards. So revised standard sales minus budgeted sales. So revised standard sales is same as what you arrived in the earlier mix formula. So you need to take the proportion of actuals compared to your total sales, compared with standards. Okay, standards, total quantity of standards compared with actuals, whatever you have arrived at. So that proportionate, if you take, that gives you revised standard sales. I think that is a thing what is there in your standard costing. So standard costing talks about all these factors, and it is very key that we need to do the variance part in a very proper manner. So in order to understand the formulas, I will be telling you one shortcut method, or by using a table, I will just tell you how it should be arrived at. So when we do the problems, first I will show the table, and that is one best way of remembering the formula. So whenever you want to remember the formula, please don't do by heart it. So you just keep the formulas in a proper manner. I will tell you how to do it. So I'll just give you one simple presentation of the entire formulas, wherein if you can just understand the flow of the formulas, you can just interpret those things when you want to find out what is asked in the exams. So don't ever by heart these formulas. Okay, you will get confused. So efficiency, rate, you be careful with these words, capacity and volume. These are all something you should be careful. What is that they are asking? Volume means what? Okay, capacity means what? Efficiency means what? Rate means what? Cost means what? See, you need to have some basic understanding of these terminologies. These things should be there in your mind, so that you can easily predict what should be there in the brackets. So I'll tell you how to do this problem. We'll solve some problems on this. So I'll prepare I have a chart for this. I'll just show you a simple way to remember these formulas in my next presentation.
Subscribe to LearnCab and hit the bell icon to get notified.